Well, hello everyone, and welcome to this session with Tierra Bonds. We're going to be talking about credit and the game plan to excellent credit. So thank you for being here. I'm Jay Lyman. I'm a librarian with the Seattle Public Library, and I want to thank you all for being here. If you're watching this after the fact, thank you for watching also. We are recording today, so we want you to know that we're going to post this online, and so some folks might actually be watching this from the library's YouTube channel after the fact. With that, I'm sure I'll have other things to chime in with as we go, and so do put questions in the chat so that we can address those either in the moment or after the recording stops. And I think I'll just turn time over to Tierra to introduce herself, and thank you for being here too, Tierra. Take it away.
No, thank you for having me, Jay, and thank you to everyone else who has showed up. For yourself, credit isn't the most fun thing to talk about. For me, it is, but just congratulations to you guys for taking the time to invest in yourself and or your business if you are a business owner. And just give me a second to share my slides. All right. Well, thank you for the introduction, Jay. I am Tierra Bonds, the founder of Take Charge Consulting. And this workshop will be the game plan to excellent credit. And we'll go over 7 tips and tools that you can use to work on increasing your credit score today, or whenever you are able to get started. Let me just change my view. There we go. So at Take Charge, we believe that credit and entrepreneurship are tools that we can use to narrow the wealth gap and empower women and minorities. And we do that by, working with individuals on a one-to-one basis and taking the credit repair out of their hands and doing it for them. And then we also do this by partnering with organizations like the Seattle Public Library and Habitat for Humanity, where we're able to offer workshops like this, and also one-to-ones, which we'll talk about at the end, that the library is able to provide complimentary. So before we get into it, I wanted to go over the benefits of excellent credit. And we know we need credit to buy a home, to get a mortgage, unless we are able to do that in cash. We also know good credit can help us with obtaining a specific career that you want, to getting the best premiums when it comes to insurance, and then all of these other things. But it also comes into a play with the amount that we're paying when we're borrowing money. That's a huge factor to a huge reason that we should be paying attention to our credit and getting it to the best place possible before we go and borrow money, should we ever need to. And Jay reminded me, should I slow down for the captioners?
Yes.
Okay.
I think you're at a good rate. I'll let them chime in, maybe in the chat if you need you to slow down.
Okay. Yes, huge thanks to our captioners who are also helping us bring this workshop to everyone and make it accessible. So when it comes to a car, this is a perfect example. Everything is the same in this scenario except the credit score. So you'll see on the left side that credit score is a 760, and we're comparing it to the right side, which is a credit score of 630. Good speed, awesome. And so with everything else being the same, the car, it's the same car for $30,000, the same term, so it's a 60-month term. The only thing difference is the credit score, and the lower credit score is paying $6,600 more for that same car. And what that looks like monthly is a monthly payment of $658 compared to a monthly payment of $548. And the total interest on that the lower credit score is paying is about $9,000, which is about $6,000 more in interest alone from the higher credit score. So something as low as, a little over 100 points in your credit score can cost you thousands when it comes to purchasing a car. And it all boils down to the APR. So the higher credit score is getting 3.6, and then the lower credit score is getting 11.3%. So you can see the differences and the cost that can come your way just from having a lower credit score. And then in a bigger scenario, buying a home, which is typically, our biggest purchase investment that we make in our lives. And this is with everything being the same. And we're just comparing a 677 credit score to a 734 credit score. So less than 100-point difference. It's only about 60 points difference in the credit scores, with everything else being the same. And this is an example that I did in the beginning of 2022. So interest rates were a lot better. So you can just imagine how this would play a role now in 2023 with the rate at the rate which interest rates are now. So with the same house, the zip code being 98108, so South Seattle, and the price of the home, the average price of a home, in 2022 at this time was $625,000. And so with the same length of the mortgage being 30 years, the only thing difference being those two credit scores, the interest rates are about 0.6% different. And what that does to their monthly payments, the higher credit score, which is 734 in this example, would be paying about $2,600 a month for their mortgage. And then the lower credit score, 677, would be paying about $2,800 a month for the same house, same mortgage, everything else being the same except the credit scores. So the monthly payment, the lower credit score is paying about $200 more. But what really comes to play in this example is the interest again. So again, even with the interest being just 0.6%, so less than 1% higher, the lower credit score is paying about $2,500 more in interest every single year. And when you add that up over the lifetime of the loan, it's about $76,000 more just in interest that the lower credit score is paying. So these are just to give you an idea of what your scores can cost you, different scores, what that could cost you in the long run. And like I said, we can imagine the difference of what that would look like in a market now where the kind of the prime is much higher than both of these interest rates. So what is credit? Your credit is a 3-digit number that represents your credit profile. So it's also known as a FICO score. That's the most common language. But there are hundreds of different scoring models, and they typically range from a 300 to an 850. Again, it does depend on the scoring model that's being used. There's different scoring models for mortgage brokers and mortgage lenders that they look at when you're applying for a mortgage. And there's different ones that a dealership or your bank might look at if you're applying for an auto loan. So there's many, many different scoring models, but typically 300 to 850 is the standard range. And even within the different scoring models, if you have the basic 7 strategies that we'll get into a little bit later, if you're doing all of those correctly, regardless of which scoring model is being used, you'll have a, your score will be at the optimal within any scoring model. So if you're following the 7 strategies, then it doesn't matter which scoring model is used, but know that it will fluctuate. So with it, the credit scores ranging from 300 to 850, an excellent credit score is anything above a 730. And again, it's different within different scoring models, but that's the advice I give my clients who are looking to buy a home. That example that we saw, the higher credit score was a 734. So it doesn't necessarily need to be an 800 or an 850, but at a 730 and anything above, you're in a range where you're getting the interest rates that you're getting are most likely the best that they can be. So anything above a 730 should be your goal if you're looking to purchase or borrow any money. So how is credit established? There's one of 2 ways credit can be established. The most common way is through our Social Security number. And the way that it's established through our Social Security number, let me fast forward, is by obtaining a positive account to your credit report. So you yourself getting a credit card or an auto loan, or any other type of account that reports to your credit report, or you can establish credit by having a negative account be reported to your credit report. So that would be a collection agency or a creditor having a debt that you owe that they report to the credit bureaus. So of course we want to be on the positive side. So we want to establish credit on our own by opening an account, and that will, set you up on the right path. And there are ways that you can go about disputing and coming back from having negative accounts on your credit report, which we'll get into in a little bit. And then aside from the Social Security number route, the other route is with your I-10. So your individual tax identification number. And this, in most cases, can be used exactly as you use your Social Security number. So if you don't have an SSN and you're applying for a credit card, you can use your I-10 number on most credit cards. You'll have to do some research on which ones accept I-10s, but typically, whenever you see the place for your social, you can put your I-10. And then it's kind of the same way of establishing credit, getting a positive account that reports to the credit bureaus, and avoiding having negative accounts be sent there first. So the game plan to excellent credit is what we're all here for, I hope. And to make it really, really simple, it's these 3 areas. So rebuilding, repair, and then maintaining. So you may find yourself in, needing to build your credit as well as repair it. So maybe you have some negative accounts on there and no positive accounts. You definitely want to focus on both the rebuild and repair, or you might be in a situation where you just need to build it or rebuild it. So you've had credit in the past, those negative marks are gone, and so now you just need to rebuild credit. So figuring out where you are there will help you identify which ingredients you need to add to your game plan to reach excellent credit. And we'll go over these a little bit in depth for each area. So starting with the building, like I said, to establish credit, you want to add a positive account to your credit profile. And so one way to do that is by establishing installment accounts. And your installment accounts are typically any type of loan. So your mortgages, your auto loans, personal loans, all of those are considered installment accounts. And one that's posted here is Credit Strong. So installment accounts, typically in the traditional sense, you're borrowing money. There are products like Credit Strong where you do not have to borrow money, but it will report as an installment account on your credit profile. So what Credit Strong does is gives you a kind of like a forced savings account. So instead of paying monthly to a loan, so instead of paying your monthly car payment, you're paying monthly into Credit Strong, which holds that money into a savings account. So on your report, it looks like a loan, but then at the end of that term, which you get to decide what that is, typically 12 to 24 months. At the end of that term, you get that money that you've put in there sent to you in a check or deposited into your bank account. So it suffices as an installment account reporting, but it doesn't require you to borrow money like other installment accounts. So it's a really good one to get started with building credit, because the tricky thing is when you're building credit, you know, you need to get an installment account, but in order to get approved, you know, if you just go to a dealership or go to your bank and get an installment and apply for an installment account with no credit, you will probably get denied. So it leaves you in that really tricky spot of how do I get approved when I don't have anything for them to approve me based on, you know. So the Credit Strong allows you to get approved for the account and also start saving money. And then another way to start building or rebuilding credit is getting revolving accounts. So, and the same situation for installment accounts applies for revolving. If you go apply for a credit card, which is a revolving account, they're going to want to see your history with revolving accounts and your history with credit. So if you don't have any established, it puts you in that tricky position of, okay, how do I start building credit? Getting a credit builder card is a really, really good way to start. You can also check with your own bank, your own financial institution, and see if you can get a secured credit card through them. And so a secured credit card is a revolving account, but it's not a traditional credit card, as in it's unsecured. So your traditional credit cards, the bank will just extend a certain amount of money to you, which is your credit limit, and then you're able to borrow up until that credit limit. Whereas a secured card, you are putting the deposit, which becomes your credit limit, and then you're able to borrow up until that amount. So they report the same on your credit report, but when you're in the building or rebuilding stage, you probably have to start with a secured credit card. So the credit builder card will approve you unless you're going through a bankruptcy, whereas there are instances I've seen where people go to their financial institution, they have their deposit for their secured credit card, but they still get denied because the bank or credit union doesn't have anything to base the approval off of. So Credit Strong and Credit Builder are two really good accounts to get started with to help you establish credit. And then for those who already have credit cards and have some history with credit, and you're working on increasing your credit score, a few ideas for you would be, and this is for those with credit card balances. So if you're just starting out, you want to make sure that you're keeping your credit card balances around 5 to 7%. Under 30% is great, but to get the most points in that area, 5 to 7%. But if you are, you've got credit established, you've got some balances on your credit cards that you're unable to pay, the one thing you can do is look into a balance transfer. So what that will do, and you want to make sure that you're reading the qualifications before applying, because you don't want to waste an inquiry on applying and then you're not able to get approved. So balance transfers allow you to get a new credit card. Many of them have introductory offers. So they will offer you 0% interest for 12 months or 18 months or 15 months, whatever it is, which allows you to transfer the balance from your existing credit card to the new credit card. And what you're doing is saving money every single month on interest. So it allows you to pay down the balance much, much faster than if you kept it on the card with the interest accruing. And then another option is to increase your credit card limits. So if you're in a position where you've got balances on your credit cards, one thing you can do to lower your utilization is to increase the limits that you have available. And then not spend up until that limit. So keep your spending where it's at. Increasing the limit will allow you to lower your utilization. And you can do that with, a simple phone call to your bank, assuming that your credit is in a position where you would get approved for that. So that's kind of the rebuilding side. The goal there is to add positive accounts, so add an installment account and or revolving account, or optimize the ones that you already have. So if you've already got credit cards, lower the balances on there in any form that you can. And then the next step, or the next kind of ingredient for excellent credit is repairing your credit. So the repair and the rebuilding addresses your positive accounts. The rebuilding addresses your positive accounts, and then the repair is addressing the negative accounts on your credit report. So because of the Fair Credit Reporting Act, the FCRA, it was created to protect consumers. So the way things are negatively reported to our credit report is by a collection agency or a creditor reporting specific accounts to the credit bureaus. And what that does, and if you're not familiar with collection accounts, that is amazing. But what that does to your score is it can drop your score about 100 points just from having a new negative collection account or charge off on your credit report. And so because of the FCRA, it allows us to dispute those items on our credit report. And the cool thing is this is for accounts that the disputing comes into to play if you've got things that are inaccurate on your credit report, so things that are not yours. It's great for that, but we can also use the FCRA for accounts that very well may, are our accounts. And what we're disputing on is the accuracy of the way that the account is reporting. So not necessarily, the accuracy of the account being yours. If that is the case, definitely dispute that. But more commonly, we are disputing the validity of the way that the account is being reported. So the steps to do this, and I'll just touch briefly on it because I want to make sure we get to the 7 strategies. But getting your credit report, looking over it. So first you want to examine the accounts that are not yours. Definitely want to point those out first. And then the other step is looking at accounts that are yours. Maybe it's a medical bill that you weren't aware of, but that you did get service there and that the amount they're saying you owe is valid. You want to look over that account and see how it's reporting to the credit bureaus. So using a credit report that has your full report from all 3 bureaus, so Experian, Equifax, and TransUnion, will allow you to see the differences in the way that they're reporting. So they might have, the amount correct on all three credit bureaus, but maybe the date open is different from TransUnion to Experian, or maybe the high balance on the credit report is different from Equifax to TransUnion. So you want to be looking at those little tiny errors in the way that it's reporting, and then use that as your reasoning for disputing. So once you figure out what those are, you want to write a letter to the credit bureaus. And this letter can be, very simple, very brief and short, but basically you want to point out the accounts that you're addressing, why you're disputing it, and you want to make sure that you send it with your personal information, so that they know it's you. So having your social security number, your date of birth, name and address, so that they know it's coming from you. And then once the credit bureaus get those letters, they have 30 days to do what they call an investigation. And in that investigation, what's happening is the credit bureaus are reaching out to the creditors and or collection agencies, wherever that account, whoever is reporting that account. They're reaching out to them, trying to get documentation that they should already have, and they only have 30 days to do so. So typically what happens is the credit bureaus will not be able to get that information, and then they have to go and remove it from your credit report. The other common action is they do get documentation back from the collection agency or creditors, and then they just update it on your credit report. So they might say, oh yes, the date open was incorrect, and now we've updated it. So everything is fine. And then the last option, action item that can happen is they send you the credit bureau send you a response saying that they need more information from you, or all of these different type of stall tactics. And what that's doing is giving them the 30 days, or giving them, showing that they've responded to you within the 30 days required by the law. So with that, you want to just be very, very persistent. So if you get a response from the credit bureaus that says, we need more information, or we've reviewed this and it's accurate, or we will not investigate anymore, whatever their response is, you want to be persistent and pretty much always send them something back, because the persistency is what can help in getting those accounts removed. The credit bureaus are banking on the fact that most consumers will, if they even do send one dispute letter, that's the last letter that they will send. So they're kind of going by that. So the more persistent you are, the more results that you can get in that repair process. All right. Does anyone have any questions at the moment? If so, we can pause the recording. I just want to. Awesome. Thank you, Jay. So I do see one question. If you have a back and forth with the credit agency over dispute letters, does that restart their 30 days? Very, very good question. And I've read both. So in some instances, and it depends on the response that they're giving you. So if they did do a full investigation and they've updated what they needed to, or verified that everything is correct, and you send another letter, then that does restart the 30 days. But there are instances where they might be asking for additional information, and then you reply, and then it changes to 15 days. So, and that can get pretty tricky. One thing you can do is, work with a reputable credit repair company, or just look into the FCRA. So that's a document that shows exactly what the credit bureaus have to adhere to. I think that would be a really great step. It's about a 70-page document, but you'll be able to find in there what are the exact guidelines and when it changes from 30 days to 15 days. Great question. Will you guys address if and when bankruptcy is necessary? That is a good question. Also, I don't have that in this workshop, but I can thank you for asking. That's definitely important because I get a lot of people who have already reached out to a bankruptcy attorney, and fortunately, they were able to get a referral to us. And then I look at their credit report, and bankruptcy isn't even close to being needed, in my opinion. So it's a little bit tricky, and it's different for everyone's credit profile. But like I said, most of the reports that I have seen, bankruptcy isn't worth it. And that's just because the amount of debt that they have, a lot of it can be deleted if we dispute it correctly, or there are options for them to rearrange some things and be able to pay off their outstanding balances rather than do a bankruptcy that will impact them for 7 or 10 years. So definitely a case-by-case basis. And I think maybe, you know, getting with a credit consultant and a bankruptcy attorney so that you've got 2 different perspectives would be a good idea. I'm not a bankruptcy attorney, so I can't give, you know, a for sure yes or no. But again, I think consulting with a credit professional and a bankruptcy attorney and getting feedback from both would be a good idea to determine if bankruptcy is a good route to go. Awesome. Very good question. So we talked about the rebuilding side of things and the repair. And then the next part is the 7 strategies to take charge of your credit. So this is for people who are working on rebuilding and repairing, but also for people who don't need to do any of that. You know, you've got excellent credit already, and then you just want to ensure that you're in a position to keep it that way. So number 1 is monitoring your credit. This is really basic, but often overlooked. And there's, you know, I get a lot of people asking, how much will my credit be impacted if I check my credit myself? And the answer is none. You're able to check your credit report as many times as you would like. And the more often you do it, the better. And when you're checking your credit, you want to make sure that you're using a system that has your credit report from all 3 credit bureaus. So Experian, Equifax, and TransUnion. And then the best route is one that allows you to see your credit report against all 3 credit bureaus side by side. So then you're able to compare what each credit bureau is saying very, very easily. And we'll include the link to Identity IQ. This is what I personally use, and then my clients use as well. So I will send that to Jay so he can send it out in the follow-up. Number 2, another kind of thing that we all know to pay our bills on time, but things do come up. And when it comes to your credit, if you are in a position where you have to choose between different bills, you want to make sure that you're choosing ones that first, you know, are necessary. So anything that involves your safety, but then second, the ones that report to the credit bureaus. So things like our rent, for example, it doesn't report to the credit bureaus. If you have a mortgage, yes, that does, but rent payments do not report to the credit bureaus. And so if it's between, you know, your car payment and your rent, and you're, you know, going to be 3 days late or 5 days late, you want to prioritize what's reporting to your credit report. You know that with your rent, you've got such and such time frame to bring it current and pay it, whereas it won't affect your credit report. But with things that are reporting to your credit report, once those are over 30 days, you're immediately getting a late payment, and that can drop your score about 100 points. So not to, put you in a position to choose between different bills, but if you are there, add some extra thought around the ones that do report to your credit report, because you don't want to have, a late fee plus a ding on your credit. So that can help in prioritizing different bills that need to be paid. And then to help with paying bills on time, checking your mail regularly is really important, because that can avoid new collections being on your credit report. So something like a medical bill where you weren't aware that you would owe anything, you thought your insurance would take care of it, which is very, very common. Medical bills are the #1 cause of bankruptcy and bad credit. So checking your mail regularly can allow you some time to look into those accounts and reach out to your insurance provider or the clinic, and handle that before it gets to your credit report. And also, having your bills on auto pay will definitely help with that. And one story here, just to kind of stress the importance and how easy it can be to get a late payment. I helped a friend increase her credit score. She only had a couple things on there, but we increased her credit score. She bought a home in 2020, and then decided to buy a different home the next year, so 2021. And she simply just forgot that when she bought the new home that she didn't set up the auto pay automatically. She was a single mom, a business owner, and just with all of the life stuff, she was just so used to having her mortgage come out automatically and forgot to do it with the new one and got a late payment. Fortunately, we were able to dispute it and get the late payment removed. That was something that the credit bureaus were a lot more lenient on during the pandemic, but we were able to get that removed. And her score was back to normal. But for those few months in between, she had, her score was impacted extremely high just because of that one new late payment. So that's why I stress the importance of making sure that whatever bills are being reported to the credit bureaus, make sure that those are paid on time. So your mortgages, student loans, credit cards, personal loans, all of those, you want to make sure that those are paid on time so that your score isn't impacted negatively. All right, and then the third thing is to keep your long-standing credit cards open. So, and this goes for installment accounts too. So, which sometimes we cannot just keep those open, but you'll notice that once you pay off an installment account, like a loan or student loan or auto loan, you'll see that your score goes down a little bit, but it's a little bit more of an impact with credit cards. So that's why you'll hear people say, don't close your old credit cards, because those older ones have so much history, and it impacts the average length of history, which is 15% of your score. So if you are closing out the oldest one, and especially if you have a lot of new ones, that's going to decrease your average length of history drastically, and impact your score. So we want to make sure that we're keeping those old ones open, so that we're getting the highest length of history that we can. Now, there are some instances where closing old credit cards might be more beneficial. For example, cards that have, high annual fees that you have to pay every year that you're not getting an ROI on. So if you've got a $550 annual fee in it's a travel card and you're not traveling anymore, you're not, using that card, you're not getting any points out of it to make up for the $550, that might be something you consider closing, but you definitely want to know how it will impact your score ahead of time. So you want to look at your report and maybe it's at a time where you don't have any newer credit cards. So you don't have anything outweighing your average length of history on the new side. That might be a good time to think about getting it closed. But definitely something you can consult with a credit consultant that can let you know the impacts of closing that card before you do it. Another option is to use Identity IQ, which we talked about in number 1. So you're able to look at your report from there, but they also have a simulator where you can see what different scenarios will do to your credit score. So you can see what will happen if you close out this card that you've had for 22 years, and it will show you what your score will be like if you do that. So again, we will send that link in the follow-up. Number 4 is keeping a good mix of credit. So I've been saying installment accounts and revolving accounts quite a bit lately in this workshop, and I apologize for if those words aren't familiar to you. But installment accounts are any account that reports as a loan on your credit report and has a fixed amount. So for example, your student loans and your auto loan, there's a fixed amount that you've borrowed, and then you have fixed payments. So your monthly payment is the same every single month. And you know exactly how long you're going to be paying that amount. So example is the car example that we talked about in the beginning. The fixed loan amount was $30,000. The fixed payments were whatever that monthly payment was. And then the time frame was the amount of the loan, so 60 months. So anything like that, if it has those 3 criteria, will often be an installment account, and that's in comparison to revolving accounts on your credit report. So those are all of your any type of credit card. So you can continuously borrow, whereas with an installment account, you've got that fixed amount, you've already borrowed it, and it's kind of done. With installment accounts, you can borrow over and over up until that credit limit. And then your monthly payments are differentiate based on the balance that you have on the credit card. So with revolving credit, you'll get a minimum monthly payment. And so that's based off of a percentage of the balance that you're carrying on that card. And with both accounts, you can pay more than the minimum on your credit card, which you should. And then on the installment accounts, you can pay more than the fixed monthly payment, but it just has those guidelines to distinguish between an installment and revolving account. All right, so number 5 is being strategic when it comes to applying for credit. So inquiries are 10% of your score. And there are times where multiple inquiries can count as one inquiry. One example is, again, back to the car. We'll go back to the car example. When you are applying for an auto loan, you have, and again, it's different between whichever scoring model is being used, but you have about 7 days to shop around. So you can apply at a dealership, you can apply at your bank or credit union, and all of those inquiries within a certain amount of period will count as one. So, and the reason that they do this is because lenders like to see that shopping around to get the best rate is responsible in their eyes. but you just want to make sure that you're doing it within a short time period. Like I said, each scoring model has they calculate that differently. So if you're doing it all within 7 days, no matter which scoring model is being used, it will count as 1. Some other examples that you can do that with are personal loans, student loans, mortgages. The big one you want to remember that you cannot kind of shop around and only use one inquiry is with credit cards. For some reason, that one is identified differently. And it's not smart to shop around when it comes to credit cards. So being very, very strategic, you don't want to exceed 2 hard inquiries in a 12-month period. So on your credit report, it will show all of your inquiries within the last 24 months, but the only ones that take a toll on your credit score are the hard inquiries in the last 12 months. And so the difference between hard and soft inquiries are typically done for background purposes. So if you are applying for a job or a contract, or to rent an apartment, and they need to do a background check, those ones are all soft. Whereas your hard inquiries are when you're borrowing money. So that's the easiest way to look at it. If you're applying for money, whether through a student loan, a mortgage, a credit card, those will be hard inquiries. But if it's done for the purposes of background, insurance, job, or renting, those will be soft inquiries. And again, you'll see them both on your credit report, the ones that are in the last 24 months. But the only ones impacting your score are the ones in the last 12 months that are hard inquiries. All right, soft versus hard inquiries. Oh, perfect. I hope that helped to answer the soft versus hard inquiries. Awesome. All right, number 6, keeping your credit card balances low. And we talked about this earlier in the workshop, but your total credit card utilization should be under 30%. So the best kind of sweet spot to be in is between 5 and 7%. And that's where you get the most points in the utilization category, which is 30% of your score. So 30% of your score is based on just how you use credit cards. So one question I get often is, do I need to use credit cards to have a good score? And unfortunately, or fortunately, depending on the way that you look at it, but the answer is yes, because 1/3 of your score is based on how you're using those credit cards. So if you have none, you're immediately missing out on 30% of your score. And then to determine your utilization, what you want to do is add up all of your credit card balances and then divide them by all of your credit card limits. And so again, anything under 30% for utilization is great, but 5 to 7% is where you will get the most points in that category. And then number 7 is disputing negative items on your credit report. So if you don't remember anything from this workshop, the biggest takeaway I would say to remember is that paying collections that are already on your credit report is not a means to fix your credit. I personally thought that that's the way credit worked. If you just pay the collections on your credit report, then you don't have any debt and your score would be fine. The way that it works though is the collections, regardless of the balance that's shown, it could be $8,000, $400, or 0. It still reports as a collection account. So on your credit report, you'll see that it is a collection account or charge off. Those are very, very similar. And the balance isn't factored into the scoring model. So balances are factored in with our credit cards. So the open credit cards that we have on our credit report, the balances of those impact our utilization. But with negative accounts, collections and charge-offs, the balances have no impact on our score. So if you take away one thing, I hope it's that if you do have collections on your credit report, look into other routes for fixing your credit, you know, disputing them on your own, working with a credit consulting company. And then the last step is just, you know, waiting until they fall off of your credit report. So just remember that paying those ones already on your report doesn't help your score. But if you, you know, check your mail and you see something from a collection agency and that account is not on your credit report, you definitely want to handle it before it does get to your credit. And I think that is it. We went over the 7 strategies, but you know, basically paying your bills on time, checking your credit, keeping your old accounts open, having a good mix of credit, so having both revolving and installment accounts reporting to your credit report, being strategic when you're applying for credit, keeping your credit card balances low, of course, and then disputing negative items on your credit report. So those are the 7 strategies. My clients go through a process that helps them walk through these 7 steps, but then also we handle the repair and the rebuilding. So with those 3 kind of things, we're able to get our clients to their goals within 6 to 9 months. And definitely something you can do on your own. It just takes a lot of time learning the laws. And if this is of interest, I would definitely look into the FCRA, the Fair Credit Reporting Act, so you can get an idea of what is available to us as consumers to protect ourselves, and then what the credit bureaus and collection agencies have to abide by. All right, so next steps, reviewing your credit report and identifying what's needed to increase your credit score. And I think this is very useful for those, even if you don't have, you know, an immediate need for credit right now. I think that's the best time to start working on your credit, so that if down the road, you know, there's an opportunity for you to get, you know, an amazing deal on a home, or, you know, the car that you want, you're finally in a position to financially afford it. You don't want to have to start then at that point fixing your credit. So if you're able to get it to where you want it to be now, that's the best option. The sooner the better. And then second step would be to schedule your complimentary one-to-one, which Jay will post in the chat. This is where you and I and someone from the library, either Jay or Carmen, will be able to sit down, go through your credit report, answer any questions you have personally on your credit, in a safe environment. So with someone that you can trust, that will, you know, everything is confidential in those calls. And then Jay or Carmen are able to take notes so that you're able to, you know, have a step-by-step of what to do after we meet, and figure out what it is that we need to do to get you to your credit goals. Those calls can also be used just to understand your credit report. We can go through it account by account, and make sure you know what it is that you're looking at, and that those accounts are accurate and yours, and then identify next steps to help you optimize your credit score. So those are offered with a huge thanks to the Seattle Public Library and the Seattle Public Foundation. If you're watching the recording, definitely keep checking the library's website, because we look forward to offering those in the future as well. But right now we have a limited amount. So if you're on the call, feel free to schedule those. Will these slides be available? Yes, I can send these slides in a follow-up email as well. And then I think we're going to stop the recording and then see if there are any questions.